a sort of an overall reduction in focus industry-wide while we all waited for Basel to make this decision around capital floors. If you remember, it was expected in January this year, but there's been a lot of negotiations since. But we're very excited to see fresh energy in this space and expect to see it as a much higher profile for the next couple of years. First, to introduce the team, I'm Katherine Martin, a director here at PwC, and I'm the Australian leader for our response to Basel IV. I've been at PwC for 2 years now, previously having worked for Westpac, for Barclays, at a fintech for a while as well, and also at the FSA, the UK regulator, right through the heart of the financial crisis. You're all welcome to find me on LinkedIn and connect. It's probably a good way to keep up to date on Basel IV changes and also just generally around APRA and regulatory changes that we're seeing in the Australian marketplace. I'm supported by a great team of experts in Australia, shown on this slide, as well as a strong global team led out of Europe. We will be continuing to keep an eye on all changes and keep you up to date. And if you haven't already, although most people probably on this list have, on this call have, but if you haven't, please register at our website shown on the screen there, pwc.com.au/Basel IV for updates and information. We are in the process of updating a lot of our collateral on there, so some of it's slightly out of date as of last week, but we're sort of rushing through a lot of changes on that, and we'll update people as that comes through. So a little bit of background on how we got to where we are. So the Basel reforms, as I'm sure everyone knows, have been running for almost 30 years now. Basel III being the post-crisis reforms, initially focused on capital definitions, what we often refer to as above-the-line changes to strengthen the overall capital levels and instruments across banks. Basel IV is an industry term, which we are generally using to refer to the range of changes below the line, i.e. the definition of risk-weighted assets. This encompasses a range of regulatory changes to credit, market, op risk, and as well the capital floor, which in our mind is sufficiently comprehensive and consolidated to be referred to as Basel IV. We'll be guided by industry for this, but just wanted to clarify the definition that we're using at the moment. But let's cut to the chase. The most exciting bit of the recent announcement last week has been the confirmation of the capital floor at 72.5%. This means that banks need to calculate their capital requirements using standard approach across all risk classes first, and then again using their internal models. The capital required under internal models cannot be less than 72.5% of the standard approach. This is part of Basel's goal to reduce the variability of capital outcomes and to reduce reliance on black box style internal models. Rightly or wrongly, there's been an impression that these models can conceal risk, and the floor is an attempt to reduce the impression that this is taking place. And it also confirmed the timeline, of course, that all the major risk classes for Basel IV will go live on the 1st of January 2022 with a 5-year phase-in for the capital floor. One of my clients also mentioned to me when I said this was that that's also when when LIBOR ends, so there's a lot of activity that's going to take place. So it's still 4 years away, still plenty to do. It's been an interesting year while this has been negotiated. As I mentioned, this was expected to take place in January, and we know there was a lot of push and pull largely from the US, who wanted the higher rate of 75%, and I think the French, who pushed very hard for 70%. I think because of the different way the markets are structured, obviously the US market is a much more securitized market. Europe has a lot of high risk weight style residential lending, but hasn't really had any real evidence of it being a major risk point. So just different approaches, and that's really what's reflected the time it's taken to come to this agreement. The agreement at 72.5 is obviously a compromise between those two numbers, but I would say that there's also been a reduction in the risk weights on the credit risk side of things. So you could say fairly reasonably strong win for the European approach by reducing both the standard approach results as well as the internal models, the capital floor that it can be applied at. We've shown here as well that APRA obviously have their own reform agenda, driven both by Basel, but as much by the FSI. And Wayne Byers has called out the link to Basel on a number of occasions. In July, we saw, I think, some pretty clear frustration with, by APRA with the pace of Basel decisions, which led to their unquestionably strong guidance. So speaking of APRA, it was really pleasing to see that their response, they sent out a press release immediately following the BCBS announcement. It's good to see they're fully engaged with the negotiation, which is no surprise really. APRA have always been strong supporters of Basel reforms and have implemented the standards largely in line with Basel requirements. I've had a lot of client conversations around whether APRA were likely to implement all of the changes. And my view is that APRA have always done so, and there's no reason to think that they wouldn't this time. I would say, though, that APRA have also taken a pragmatic view of many regulations and tailored the requirements to Australia where it's needed and appropriate. We've seen this in the implementation of LCR, in the way in which they've set minimum risk weights for internal models, credit, and in other areas. So I think it's really pleasing to see that they're strongly engaged. One of the big questions that we often have is around FRTB and the fact that market risk in Australia is such a small proportion of the overall risk, and is it reasonable and proportionate and appropriate to apply the full market risk capital changes? And I would fall back on my same comment, which is that APRA always have, and unless they have a good reason, that I would expect that I would assume that they would apply the Basel changes. I'm going to talk a little more later about the fact that the capital floor is set at the bank-wide approach, which I think is a very interesting sort of nuance. We'll cover that a little later. APRA press release also called out that the capital increases were expected to be accommodated within the July 2017 announcements. Although in that paper, APRA did discuss in detail how they would like the banks to remain in the top quartile of global banks. Rereading it the other day, I did realize it wasn't quite as specific to say that they would slavishly follow the top quartile, but definitely some detailed analysis as to how the top quartile is determined. I think it's easy to imply that that's where they want to be. So it's worth saying that there is an expectation that these Basel IV reforms will push up the overall global capital levels. So if that happens and it pushes the top quartile up, there may need to be some space to reconsider whether or not APRA need to push up the guidance they've given. APRA have stated in relation to Basel IV that they will start consultation in early 2018, which will be a great chance to see what they're thinking and hopefully for us all to influence the final decision. Even without the need to increase capital, there's obviously lots of work to be done by capital teams to implement these changes. So things like enhanced data requirements, model development, capital allocation, when we look at how the capital benefit can be shared across different businesses. There's a lot of internal governance processes that will need to be on top of these changes, and also a lot of liaison with regulators. So I think all of those need to be borne in mind. So a little more detail on what's actually in the announcement. So as I mentioned, capital floors is obviously the most sort of important piece that we'd all been waiting for. And in my view, one of the most important aspects of this is that the floor is set at the bank level. I always somehow fail to explain this clearly, but in my mind it means that the capital benefit, the 27.5%, can be spread, doesn't need to be spread evenly around the risk types. So since there's no longer an option to use advanced models for op risk, credit and market risk can actually take more advantage than the 72.5% would make it appear. So if your internal models come in at sort of 65% for credit, it's quite possible that you will still be able to use that in your capital calculation because there's no reduction in the op risk, for example. Other changes, so credit risk, as mentioned, basically more risk sensitive, a lower overall standard approach charge, which Nick and Jack down in Melbourne will cover in a little bit more detail. Also changes to the internal models approaches and what can be done there. Market risk, no real change actually in this announcement other than confirming the extended date. Current work in this area continues to be a focus on the boundary between trading book and banking book. And I think there's still some hope, though despite this being finalized, that some changes will come through for the more difficult technical areas, such as non-modelable risk factors, P&L attribution, and the like. Op risk, as mentioned, there's no allowance anymore for advanced for advanced approaches, and Ninad will cover this in a little more detail. So that's a pretty much whistle-stop tour of the changes. And to give a tiny bit more detail, and to give, I think, a bit more Australia focus on the residential risk weights, and which is obviously the most critical part of the Australian impact, I'm going to hand over now down to Nick and Jack in Melbourne, who are our credit experts. So let's hope the technology switches over here nicely. Nick, Jack?
Hello. Thanks for the handover, Kath, and thanks for everyone for joining us today on a very sunny Friday afternoon. I'm going to talk through some of the final rules as it impacts residential mortgages. It's obviously very critical in the Australian market. It also won't be a surprise to many people that have been following the Basel announcements. I guess overall there's no big bang, I guess, for the Australian market, given that the Australian market have been using a risk weight scale based on the LVR, or the LTV as Basel calls it. The critical change, which is a major concession, is a 5-point reduction across the board for the standardised risk weights. So this is a much more favourable outcome for Australian banks in particular. Provided a chart there which compares the Basel general treatment risk weights versus what the existing risk weights are under APS 112. Based on our estimates, given a typical portfolio mix for the Australian majors, the impact of the standalone capital for mortgages is slight. It's just below the current average risk weight of 25%, post the change of unquestionably strong. You'll see there that there's very low risk weights applied for LVRs less than 50%, which is considerably lower than the risk weight of 35%, which applies currently. Important point about the LVR calculation itself, it's based on the origination value of the property. So in practice in the Australian market, the origination value has been used in the standardised approach, but there's been some leeway to revalue the property, given any change in the structure of the loan. But we believe this will create an opportunity to optimise the risk weights for mortgages by having loans churn through the market. So obviously if the loan's refied, then when it comes on the books for the next bank, they're able to pick up any change in the value of the property. I guess the two wild cards are, apart from the standardised approach itself, is this new category called income-producing residential real estate. Now this introduces a new set of risk weights that could apply to residential mortgages. This is something that's been certainly picked up by the analysts as a potential impact on the overall capital requirement for mortgages. So Basel defines this as any loan in which the serviceability is materially dependent upon the cash flow of the property itself. Now the only additional guidance from this is in a footnote, which will probably become one of the more important footnotes in the Basel rules, and that is that it can apply to borrowers other than corporates, SMEs, or SPVs. So they're expecting that it can apply to individuals, and that a loan may be considered materially dependent if more than 50% of the income from the borrower is used in the bank's assessment of serviceability. So we think that will come into play when when the local supervisor considers interest-only investor loans in particular, where there's been some concern about serviceability, or any other segments which rely critically upon the income of the property. Comparatively to that is this new set of requirements called the operational requirements. Now again, this does intersect with some of the requirements in the existing standard, but Basel make this more explicit. So this includes 6 requirements. And Jack, would you like to go through this list for us?
Sure. Now, I'd just like to really probably call out a couple of these rather than go through every single one of them. I think the devil's always in the detail with these items. And the couple that I would like to call out is the ability of the borrower to repay. So it's very much in in the standard there that the supervisor needs to define criteria there. Obviously in Australia there are already some conversations and information out about that, so whether or not that will just continue and whether responsible lending then obviously becomes a bit of an overlap in that space. The other one's the prudent value of property valuations. So that's another one where the supervisor is requested to look at that and define what that is. There's also kind of an interesting, almost like an anti-real estate bubble proviso in there, which says that it really needs to be the long-term value of the property, which also states that the current market value needs to be assessed, whether that is actually the peak of the value. So that's going to be a really interesting one, considering the conversation in Australia around whether we have or haven't a residential property price bubble at the moment, and whether how APRA may play into that as they start consulting next year and start defining some of these terms for the introduction into Australia. I mean, I think they're the two main ones that will be interesting. I think the other data gathering piece is definitely around the IPRE. So IPRE is a kind of view that we have in Australia, but defining this with its own risk weights, and then also the gathering of the data around cash flow and keeping that up to date, I think will be a really interesting one. I can see that the data piece is going to be the more interesting piece about this, and there is a desire to keep that data and to use that to start defining risk weights more so than probably they have in the past. And I think that's probably a really good positive aspect in terms of risk management throughout the economy. I don't know if there's any other things you might want to call out, Nick.
Well, I think this is a very interesting lever that APRA can pull now for a penalty capital charge for this segment. Obviously, this intersects with the current reviews on responsible lending practices and APRA's view of being able to play some role in enforcing sound lending practices. So I think that the range of these requirements which APRA can emphasise, can focus upon, can use as part of a review to actually consider if certain segments warrant a high risk weight. Now, I think obviously that's it's also an opportunity to banks to consider how they could reprice some of these segments, and we do expect some repricing to be an outcome of Basel IV.
Yes, I think that's possible. Just on to the next slide, just around internal models. Just conscious of our time. I guess the big change that's come through, and this was well signalled earlier by the committee in their drafts, that moving away from purely internal models, so certainly internal model PD, but going to a third approach for LGD and EAD across particularly large corporates, government and banks. And I think that will make it, obviously, change some of the risk settings in Australia through that process. Interesting, THRB's also been, LGD's been changed from 45% to 40%. So it'll be, in practice, may not be quite as impactful as it may have been, but will be interesting to see as that comes through. I think certainly the use of internal models for PD continuing is a really, I think, a good benefit for banks in terms of understanding their own risk. And I think that maintains, I think, the capability, but also the use of internal models for risk settings inside banks, which I think is very useful from a risk management point of view, not just a capital point of view, but also I think that we talked about repricing. Certainly PD plays a big part into pricing. I guess it's going to be the interesting one is the interplay between internal models and then how the capital floor impacts that, and whether there is, if there's a gap, how that is dealt with in pricing, or whether that's just smoothed out over the whole book, as Kat pointed out before, around the different risk weight categories. I don't know if there's any other...
Yeah, I think this is quite a big concession for Aussie banks, certainly advanced banks which have relied upon internal credit assessments, and that internal credit rating obviously plays into the PD. So there are different PDs applied for banks and large corporates, and I think that's influenced bank pricing for certain for certain counterparties. So I think this obviously preserves that. It preserves the value of that function at banks, but it also does take out some of the noise created by having different LGDs across the market.
Yeah. And just before we go, one other thing was the continued use of being able to use external ratings. That in the very early drafts, that seemed to be an item that was very much to be reviewed. So that, you know, continuing that use, I think, is probably a good thing in the market, because it does keep to less volatility between the settings with banks. Kath, we'll leave it there on time and hand it back to you.
All right, thanks, guys.
So, operational risk, it's probably worth touching on operational risk for a couple of minutes as well. So as many of you know, the new standardized approach replaces all the current approaches that we have and has two components. One's the basic indicator component, which is really a financial statement-based proxy for operational risk, and the second component is really the internal loss multiplier, which is a scaling factor based on the bank's historical average losses over the past 10 years. So the way this works is if a bank has higher internal losses compared to peers or similar-sized banks, then the multiplier is greater than 1, and therefore the bank requires more operational risk capital. Therefore, this new approach is more risk-sensitive. So this approach has been broadly unchanged since the previous versions, but there have been a few developments worth noting in the latest release. So earlier this year, we had operational ORX, which is the Operational Risk Data Exchange Association, which had estimated that most, or 3/4 of banks around the world would see an increase in operational risk capital. European banks were estimated to be the worst hit, with about 63% increases, and Australian banks were typically around the 12% average increase mark. And so globally as well, USA was around 3%, Canada was 25%. So to accommodate this variability of capital impact, some of the proposals announced last week give greater national discretion to local supervisors on certain implementation choices of the standard. The other thing that has happened since the initial impacts were calculated is Australian banks have been fined for things like bank conduct in retail and financial markets, anti-money laundering allegations, and the Royal Commission has also been announced for 2018. So there is a possibility that the increase in operational risk capital for Australian banks would be higher than originally anticipated. Now, it would be interesting to see APRA's stance on the national discretions and how they choose to implement the standard. The other changes in the final standard also include recalibration of the business indicator thresholds according to the latest QIS quiz, and defining some of the minimum thresholds for internal loss data that should be included in the calculation. So those are the main changes. At this stage, it is worth re-emphasizing the importance of internal loss data as well. So some advanced banks have had APRA-defined operational risk capital floors until the new standards have been finalized. What that means is advanced banks will need to continue to focus on improving their internal loss data, as they will be required to take 10 years of historical data into consideration when doing the standardized calculations. There are some provisions for transitional arrangements in the final standard. However, all of these are subject to supervisory approval, so APRA's approval, as you would expect. So to conclude, the increase in operational risk capital may be greater than originally anticipated for Australian banks due to more recent regulatory fines. Local supervisors have more powers for national discretion under the final standard, so it would be interesting to see what choices APRA makes. And the quality of internal loss data is particularly important and should be a focus of data management programs. So I think we can go to the next slide, which does talk about the future of RWA optimization.
So thanks, guys. So to bring it back, I guess, the discussions there are a lot around the changes to standardized approaches. And I think it's something we're sort of calling it out here because we want to ensure that the advanced banks are focused on this. Because the capital floor is driven by the standard approach. So if focusing on the early stages about how to ensure that you can calculate an efficient and accurate standard approach is a key early step. And it surprisingly has proven to be a challenge to advanced banks who've spent many years focusing on sourcing all the relevant data for the metrics that they use, but may not have immediately at their fingertips the right metrics and the right reliable source of data to optimize the standard approach results. So, and there are lots of elements that can be adjusted here. Nick's already called out the definition of IPRE, which, to ensure you have the right information to be able to classify loans as IPRE or standard residential. The risk weight in the standard approach is markedly different. So making those decisions and those assessments early on is a really important piece. Considering the operational requirements, the standard terms and conditions of mortgages being written now is still pretty important in looking at the standardized approach. I mean, Jack mentioned already the data piece, so data is just going to be ever more critical, which is a mantra I'm sure everybody has heard many times. So getting that data piece right is really important now to getting your standard approach results right, as well as before you even think about looking at your internal models results. So other areas we're giving sort of speaking to clients about focusing on, as Ninad mentioned, internal loss data for op risk. When we look at market risk, is a lot of work on moving stuff between the banking book and the trading book and ensuring those definitions are clear. And it's quite an important factor in driving business decisions and strategic decisions at this stage. So I think for us, we're just sort of calling out that, the standardized approach is actually the key early point to be looking at. So we've called out here a few of the big challenges facing banks. The overriding message is that this will be a large and complex change, as I'm sure everybody knows, expected to be significantly more internal work than the changes required for Basel III. Even if we don't need to go to the market for more capital, there's still a lot. We're seeing a lot of discussions around business model impacts and certainly business strategy, especially around lending activities, and also a fair bit in the treasury trading space as well. The reporting requirements are increased, and there's plenty of that going on already in this space. EFS, so everyone knows the reporting changes coming out of APRA is already going on. And with all this, and IFRS 9, and as a result, the move to ever more data and more reporting solutions is only going to accelerate. Our view is also that banks need to ensure they leave enough time to interact with regulatory proposals, as the devil is going to be in the detail here. Engaging early and looking to the consultations is important, as is keeping an open dialogue with regulators as implementation progresses. There's a lot of model changes that need regulatory approval, a lot of stuff around desk usage, around a lot of the elements of what type of internal models you'll use, what the standard approach definitions are going to be, and with resource constraints at the regulator, as much as anywhere else, it's prudent to get your supervisors comfortable with this as early as possible. And so PwC, we have, as mentioned before, we've got a global and local approach to this. I'm not going to go through all this today. I know we're kind of over time and no one wants to listen to a sales spill. But we have a lot of work that's come out of Europe who have been working on this for a number of years. And as mentioned, I'll be leading it here locally. One of the things we do have is some really strong standard approach calculation tools for credit, for counterparty credit risks, for FRTB, op risk, which have really been sort of proof of concept tested for you in a lot of European banks. And we're really focused on bringing that to the Australian marketplace, as well as, and of course, we're looking to run some training. We'll continue with this webinar series with a bit more frequency, probably looking at FRTB early next year. We're also looking to run some intense training on Basel IV, which so feel free to reach out if there's interest in that. And of course, register on the website for regular updates. And that's sort of, so on the red side here, just cutting through to knowledge management. So a lot of information on there. We have a great poster that I think many of you got, but unfortunately it's, with all these changes, it's now out of date, so it's being re-prepared, and we will update the website when that's ready. So conscious of time, I'm going to just finish off there. Thank you very much for everyone who's attended. We will send out this pack as well as another flyer we've received from the European team, which gives us sort of the global view as to where we're going, as well as this Australian perspective. And we'll keep you updated on any future webinars. Thanks for attending.